What's up everybody, Nate here. And have you ever wondered what the most financially successful people in life all have in common? Is it that they have big brains? Is it that they're all extremely talented? Or maybe they're just all trust fund babies that got $1 million from their parents. And in some situations, one or all three of those things is definitely true. But there are three things that separate the most financially successful people in our society today from everyone else. And what's really interesting is these three things are not unique to the individuals, and literally anybody can do them. So today I want to talk about the three smartest investing habits and strategies that you can make today to become one of the most financially successful people in the world. According to the experts, literally anybody can start these three habits and strategies right away, and you will be on the path to building long-standing wealth in your entire life that will last basically your entire life and probably even future generations. All right, so the first thing that I want to talk about here is diversification. Now, why is diversification so important to investors? Well, think of it this way. So let's say you have eggs in one hand and then in the other hand you have like a basket, right? So carrying the eggs all in this hand, it's getting kind of frustrating over time. So you're like, well, what if I just put everything in this basket all on one arm? It's all in the same basket. Now I'll be able to carry everything and it's all right neatly there in the same exact spot. Well, then you start walking down the street and you don't really notice this big crack up ahead, but then you trip, and now flying out in front of you is your basket with all of your eggs, and all of your eggs eventually crack all at once. But what if you had two baskets? So now you took some of your eggs and you put them in this basket, and then you had another basket that you put another part of your eggs in. So now once you fall, only some of your eggs break over here, and you've still got a few good eggs that you can crack when you get home. Now I know what you're thinking, Nate, isn't that just a don't keep all of your eggs in one basket analogy? I mean, maybe, but who's really to say? The same exact thing works with your investments. When you start investing your money, you don't want to try to take all of your money and put it in only one thing. For instance, you don't want to solely just invest in one stock or one ETF or one mode of investing like real estate or stocks or bonds or whatever. The reason for this is because our entire market always goes in cycles. We have cycles where there's really big booms, there's lots of money coming in, and every single market is setting record highs. But those booms do not last forever. We've seen this before in American history, even just recently. At the beginning of 2020, we obviously had the pandemic, and immediately the stock market crashed. So if you were only holding on to stocks, if you were getting ready to retire because of your stock market investments, that pushed people back. They weren't able to retire quickly or right away because the stock market went down and all of their asset prices went down with them. Everything took a tumble in 2020, and then in 2021, everything went back up to new record highs. Now, there's obviously reasons for that, but at the end of the day, this is a cycle. There's booms and there's busts in our economy, and the fact of the matter is you don't know when the boom or the bust is going to happen. So what you have to do is try to spread your investments out effectively. You have to invest in a lot of different things, and I'm not telling you exactly what to invest in here, but maybe you want to put some of your money in cryptocurrency. Maybe you want to put it in some stocks, maybe some ETFs, and maybe even some real estate. That's because more than likely, not every single market in the United States is going to go down all at once. There's going to be some markets that continue to bring in value. Like you can gain a ton of passive income from real estate that, well, it doesn't really matter what is going on with the stock market because your tenants are still going to be paying you rent every single month. So you are still making money even if your stock investments are losing money. So you want to be well diversified, and not only that, but the more diversified you are, then the more gains you're going to see over time because some other markets are going to outperform other markets in the United States. That's just how it works. Fact of the matter is you don't know what markets are going to look like 5, 10, or 15 years down the road. So you have to try to be diversified and then remain as a long-term investor throughout your entire financial plan. The second thing is something that I don't hear a lot of people talk about a lot, but it's fees. So we talk a lot about on this channel that investing in 2022 is easier than it ever has been in American history. You can literally go download an app right now, and in 5 minutes, you can start buying and selling stocks on the open market and making money. Obviously, you've got to be careful with that and back it up with financial education. You don't want to just be pouring your money into a market that you don't really understand. But something that we don't talk a lot about is these apps and their fees, and brokerage fees in general can really suck up up a lot of your potential profits down the road. According to experts, well, this is one of the biggest things that you can do to hold on and to become even more wealthy in the future. You have to decide what's more important to you. Do you want to be a more active investor, or do you want to be a more passive investor? And the more passive that you get, typically there's going to be not as many fees associated with that. Like if you get a low cost, low fee ETF that basically you just buy and hold on to for 30 plus years. But if you want something a little bit more active, like a mutual fund, this is something that somebody literally watches all the time. There is a mutual fund manager that will be trading out stocks and bonds all of the time, and that's an actively managed fund that's going to typically have a much higher fee. That's how the portfolio manager makes their money. And let me put it to you this way. If you have two funds that you take $10,000 and put them into both of them, hold your money there for 40 years, and you get a typical average return of around 8%, but one fund charges 0.50% fees and the other charges 0.03% fees, which one do you think is going to be worth more after 40 years? 0.05% fee account might not sound like a lot at first, but over that 40 years, you're gonna pay over $12,000 in fees. But the other account with 0.03% fees, you're only going to pay around $800 in fees. Now, to put this into perspective, as you continue to grow your money and invest more and more, your money starts compounding, and as it compounds, the fees are also going to compound. This makes the brokerage and the fund manager richer. Meanwhile, they're taking thousands of your dollars. And you have to be careful here, because even in some passively managed ETFs or index funds, the exact same thing happens. You have really high fees associated with those portfolios because of the typical brokerage. So you have to be careful of the fees, and you have to be financially educated enough to know where exactly to put your money. Like I said, investing alone is not enough, because you don't want to invest and then lose thousands of dollars every single year. You want to kind of try to maximize your profits as much as you can, so that way you have more once you're ready to retire, or once you're ready to start pulling that money out, or just when you're ready to use it. And the third smartest thing that you can do with your investments, according to experts, is to leave your portfolio alone. Now, I know what you're thinking, Nate, the stock market is crashing right now. The Federal Reserve is raising interest rates. Shouldn't I pull my money out where I know it's going to be safe, considering it's just going to lose value in the stock market? Well, that all sounds completely logical, and I'm not going to sit here and tell you how to handle your money, but like I mentioned before, our entire economy goes in cycles. People who are the wealthiest individuals of our society today, the ones who have been investing for 30 or 40 years, didn't make all of that money by pulling it out every single time something bad happened to the stock market or the real estate market or the commodities market. More often than not, the wealthiest people in our society today are long-term investors. No matter what happens with our economy, whether we go into a downturn or the market crashes, they leave their investments in, and that's because they know our economy and our markets go in cycles. There's booms and busts, and eventually we're going to see a boom again. Now, I should clarify here that I can't guarantee that we're going to see a boom again, but if you look back in history, that has pretty much always been the standard. We had the Great Depression, and then we had really high inflation in the 70s and 80s, and of course we had the 2008 Great Recession here in the United States, but just a few years later, everything improved. Stock market again rose to record highs. During the Great Recession, we had the housing market crash, and in 2022, housing values are higher than they basically ever have been. You just need to give it time, because it doesn't really matter what's happening today, it only matters what happens 30 and 40 years from now. And you have to avoid the FOMO at all costs. The fear of missing out will kill your portfolio, and it will kill your investments. Maybe if I just pull out right now, I'll be able to time the market, and then I can buy all of these investments on the cheap. That's gonna make me a whole lot richer, but the fact of the matter is, you don't know when the market is going to go down, and you don't know when the market is going to go up. Again, I'm not telling you how to spend your money, but if you just keep everything in and consistently invest no matter what, well, then you're going to be a whole lot wealthier than if you try to continue to time the market time and time again. And like I said, it kind of seems completely opposite, because you see the stock market going down, you see that other investors are pulling their money out, but these are a lot of short-term traders. These are people that specifically make their income off of trading stocks and bonds and real estate and all of these other things. If that describes you, then you might want to pay a little bit more close attention to the markets and the analytics and the statistics and the charts and graphs and all of that stuff. But But if you are a regular everyday American that is just looking to build wealth over time, then the best thing you can do is to never touch your investment. Just continue to passively invest as much as you can. This is a proven strategy, and it's proven to build wealth over time regardless of anything that's happening with the market or our economy. It's gonna take some practice and it's gonna take some patience from your side because, again, you don't really know what's going to happen in the future. And I know you're afraid, you don't want to continue to lose money, but remember, you only lose money with your investments once you pull that money out at a loss. If you keep it in there and you haven't actually traded it out yet, then you're technically not losing any money. And this is how you need to look at the stock market or any investment for that matter. There is no guarantee that you're going to make money. Chances are your money will grow over time, but there is never a guarantee. In fact, you could lose everything. Once you take $1 or $100 or $500 and invest it in the stock market, think in your mind that that money is gone. It is spent and you're never going to get it back. If you think like that ideology, then it'll be the same exact thing as you buying a car or buying something else that you want. That money is now gone and you're never getting it back. It'll be a little bit easier to lose it because now you've kind of lost that connection to it. But at the end of the day, if it goes up, then that is brand new money and now you're making a profit. But as long as you invest solely on your plan, keep your goals in mind, always stick with it no matter what, I can almost guarantee you that you will have success like the most financially successful people do in the world. It's just gonna take time. But now I wanna hear from you on this issue. What do you think about these 3 smart investing hacks according to the experts? Are they right here? And do these strategies actually work? Or do you think that this is terrible advice and you have to avoid it at all costs? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel. And I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.